So this is the first modern reference to somebody advocating energy, using energy or encapsulating it or somehow using it to define money. And Frederick Soddy was a Nobel Prize winner in chemistry, but he wrote a monograph 100 years ago, 1921, Wealth, Virtual Wealth, and Debt. And he noted that debt grows exponentially, and in the real world, we have growth and decay everywhere. But debt tends to grow exponentially forever until you get crashes, right? And then you get super exponential crashes. And of course, we've been living, especially through that, since the Great Recession.
The opinions expressed in this podcast do not necessarily reflect the opinion of Arcos Global Advisors or its advisors. The mention of different asset types or securities do not constitute a recommendation for our clients. If you have any questions about the content of this podcast, please contact your advisor. Welcome to Navigating Bitcoin's Noise, the podcast where we cut through the clutter and bring you the clearest insights on Bitcoin. I'm your host, Kane McGukin, and today I'll be joined by Stephen Perrenod. In this episode, Stephen walks through the math behind Bitcoin's power law and shares his views on the emergence of the world's first energy-backed money. If you're tired of hype and unreliable price predictions, but want to understand Bitcoin from a first principles lens, this episode is for you. So sit back, relax, and let's get started. All right, thanks everybody for joining today. I have with me Stephen Perrenod. Stephen is a great background in astrophysicist. He also writes about Bitcoin and does a weekly, I think it is, podcast with Giovanni, and they go through the math of the power law and all the physics related math that kind of drives this network. So Stephen, thanks for joining today, and maybe you can just give us a little brief on kind of your background in astrophysics as an astrophysicist and how that kind of led you to Bitcoin or helped you see the value of this, in this case, monetary network.
Okay. Well, thanks for having me on, Kane. I appreciate it. And I started out studying astronomy and astrophysics and, spent several years as a researcher, both getting my graduate degree and as a postdoctoral researcher for several years after that. And it was extragalactic astronomy, clusters of galaxies, and X-ray emission from clusters of galaxies was sort of the main theme. But, in that you get exposed to a lot of different physics, depending on what's being described. Some of it's cosmology, some of it's astrophysics related to particular objects, and there are different, laws and physical laws. So you see different kind of phenomena. The other thing you have to do is, especially when I was in the field, which was a long time ago, many decades ago, that you didn't have that much data. You can't create experiments. You sit there and you observe and you collect as much data as you can from these very distant objects, quasars or whatever, distant clusters of galaxies at high redshifts, and you kind of have to live with what you can get from the object and from the instrumentation. So that's what I did for a number of years, and then moved into the real world and went into the supercomputing field, high performance computing. And so most of my career was in that for over 3 decades. And so I got exposed to a lot of different, really consulting, in sales support, technical sales, technical marketing, and then later sales management roles. Got exposed to a lot of different applications of supercomputers in science and in engineering, and seeing those customers, what they were doing, and obviously exposure to the computer architectures and how you adapt, algorithms to the architectures in order to solve the customer's problems in high performance computing. So that's my general background. I think it's pretty multidisciplinary. I've had titles, that were science titles. I've had engineering titles. I've had sales and marketing titles. And so it's been broad enough to look at things from a number of different angles. And I think it's very important to bring some kind of multidisciplinary thinking in order to be able to recognize Bitcoin. And I think, you know this very well. This trips up a lot of people in your industry and the financial industry because
Mhm.
they've come from that perspective, and they're trained to look at everything in terms of log normal and Gaussian distributions, and exponential growth is kind of typical for stocks and so forth, and for
Mhm.
business assets. Well, we found out, and it was Giovanni who discovered it in the 2013, 2014 timeframe. And I quasi-independently stumbled on it in, 6 years ago in 2019 when I saw an article or an Twitter post by H.C. Berger. Because I'd been playing around with different models. So I saw the power law first at that time, and then later learned about Giovanni and that he had discovered it some years earlier. And it had sort of not gotten that much awareness because he had posted, not in the right social media channels. He had posted some on Facebook and so forth, and then Reddit. And then he was off doing other things.
Isn't that interesting?
Also,
Like these
yeah,
days, you can be, and it's kind of like trading in the markets. You can be right, but too early,
yeah.
or right, but just in slightly the wrong area, and it have a very big impact on like how that spreads out.
I've got a slide that shows really when the power law kicked in and really tightened up. We may get to that.
So there's one thing right quick before we step forward that you mentioned. People on my side of the business, traditional finance, TradFi, and how difficult it is for them to grasp Bitcoin because of the network properties, the Metcalfe's law, the power law, the different modeling versus what we're accustomed to. And so most of, the 1980s forward was Pareto's principle, just kind of 80/20 and
Mhm.
probabilities and defining those probabilities and fat tails and in the, normal bell curve, which comes somewhat into play into Bitcoin at different times. But the change is that we've just moved to this more power law as a way to handle all of this data and the speed and the velocity of this data and these different networks and tied it together, which is drastically different than most of the algorithms and equations that are used to make even just basic business decisions. Is that so? I can see where it takes us maybe a decade to get that shift for the new algorithms and the new power law type thinking to be applied to business. Is that something, I know it's a little off cuff, but that you think is going on and that makes
Uh,
it
my
slower for an understanding of Bitcoin at first?
Well, it certainly makes it slower understanding. Look, my criticism of the financial industry is I think they're lazy about
Hmm.
this. They do not read the white paper.
Right.
They do not read the most important books. They could read uh, Seifstein's book. They could read Nick Batia's book. There
Hmm.
are other books they could read. They could educate themselves, but they come with opinions
Hmm.
that are not grounded in data and foundation.
Yeah, I
And
would agree with that
yeah,
totally.
yeah. So that's unscientific is how I look at it.
Yeah.
And Bitcoin is grounded in reality in a way that um, nothing in their world is. Their world is all now in fiat.
Yep.
And fiat itself is, as you know, not grounded in reality. It's grounded in committees,
Hmm.
right?
Right.
It's decision making by committees. And it could be a bank loan committee or it could be a Fed monetary policy committee, right?
Hmm.
It is multiple committees. It's not just the Fed. But and then the same is true for companies. They're pretty centralized, right? And the decision making is in the board, so it's made in committees. And yes, they may or may not. They all have to kind of live in the physical world, but depending on what they're doing, they're less grounded. They're not deeply grounded in the way that Bitcoin is. There are four main physical laws. And, people know two or three of them usually that, gravity, electromagnetism, and then you know about radiation, which is the weak nuclear force. And then there's the strong nuclear force, which just holds the nucleus together, you've heard of quarks. It's about quarks. Every one of those is either a pure power law or has a power law plus some other exponential, usually, component, like decay is an exponential process.
Mhm.
So all of our physical reality is grounded in power laws. They are very fundamental, as opposed to exponential compounding, which is, we see all the time in assets. That's actually less stable. Power
Mhm.
laws can be stable over many, many orders of magnitude in ways that exponentials are not. And the net result of that is companies tend to have pretty short lifetimes.
Yeah,
At 10 to 20 years, is
that's a
very,
big part.
yeah.
Sorry to cut you off there.
No, go.
That's a big part of the Jeffrey West scale book. That's
Yeah.
really eye-opening because he walks through all that. And just to frame up what you said there about the four physical laws in the exponential side, which is kind of man-made monetary side, is not grounded in those physical laws. So its staying power is much shorter because the exponential nature of kind of man's way of doing it burns through the energy at
Mhm.
some point way faster and more than it's readily available. So the what starts out as this thing that can be done and sustained to exponentially grow it, the maintenance of it ends up killing it off. Whereas a power law,
Mhm.
it's
Mhm.
even though it feels fast in some of these bubbles, it really is slow across time.
Right. I think that's a good frame.
So kind of piggybacking off that, you've mentioned monetary singularity and how energy as a digital money is something that we're dealing with. Some of that is on this slide here. Maybe you can explain that piece. At some point, I've heard you explain it. I couldn't repeat it, but I thought that was a pretty good way of, in the 21st century, thinking about capital versus sort of a fiat minded, sales oriented, just kind of quick hitter on getting money now and not worrying about later.
Mm. Mm. The way I put it is that money has been in need of, for centuries, a precise scientific standard definition. And it has never had it until 2009. The closest we ever got was gold, of course,
Hmm.
but the supply of gold sometimes fluctuated a lot, right? We'd get these
Hmm.
big discoveries and big finds in the New World or in California or wherever. And, now it's settled down. It's like 2% a year. So it's approximate, but it has other issues with respect to scaling, um, that, many of us know about. So what is fundamental in life and nature for humans and in our activity and in the companies we create, underneath it all is energy. Energy is foundational for all of that. I mean, even if you're building AI models, you've got to have a lot of energy for the computation, or even if you have a service industry, you need the energy to run your computers, keep the lights on, and you need all the energy that goes into your employees
Yeah, you got to
for
have
that,
human energy that
all there
feeds.
just to
Yeah.
keep them alive and healthy, right?
Hmm.
And then what they do. Uh, so energy is foundational in physics, and it's foundational in the economy. And you're familiar with the correlations between the size of the GDP and the energy consumption, right? They correlate
Hmm.
extremely well. So this is the first modern reference to somebody advocating energy, using energy or encapsulating it or somehow using it to define money. And Frederick Soddy was a Nobel Prize winner in chemistry. I'd never heard of him until, a month or two ago. But he wrote a monograph 100 years ago, 1921, Wealth, Virtual Wealth, and Debt.
Hmm.
And he noted that debt grows exponentially, and in the real world, we have growth and decay everywhere. But debt tends to grow exponentially forever until you get crashes, right? And then you get
Yep.
super exponential crashes. And of course, we've been living, especially through that, since the Great Recession.
Well, I think
And
that's a story of fiat man-made money that isn't backed by energy. It's that's the story of or the history of money for the last couple of thousand years is you go on these 200 or 300 year periods where 70, 80 years, 100 years, you have a reserve currency, and eventually there's just no way to grow your way out of debt because the energy to maintain that just eventually crashes until you build a new system. Um, so that's one question I think that I have talking about the GDP to energy relationship. If we've had these fiat monies or just kind of this natural transition a long time to new monies to try to get to a better energy money, if Bitcoin, the network, and the way the power law works allows us to store and use that energy better, and do we create energy money, and if so, does that finally give us a lasting form? We're not going to do away with boom and bust because human greed, but does that give us a stable function to maybe go longer than what we have in past?
right, right. Well, it's more stable than exponentials, and it cannot be, it can't be easily tampered with, right? You can't. It's very difficult to change the protocol
Hmm.
and the algorithm, right? So that's a source of stability. And then the power law nature is another support source of stability because power laws are more stable than exponentials in general. Um, and of course, the key is figuring out how to encapsulate it, right? How to,
Hmm.
with gold and with silver, you minted these coins and you reeded the edges, and you stamped them. And so you've encapsulated all of the history of that gold mining, the energy that went into the gold mining, the energy that, went into melting it down, putting it into bars, assaying it, securing it, and so forth. Bitcoin does that all in 10 minutes with one
Hmm.
process, right?
And with less people, unfortunately.
Right. And with, not too many people involved, a lot of computers, maybe 5 million at any given time, specialized computers with the world's largest decentralized supercomputer that encapsulates that energy in a special form through the cryptographic hashing function. So Henry Ford in the 20s talked about energy money, and Buckminster Fuller in the 60s. And then of course it got going in the more modern information age era with David Chaum in the 1980s and many, many other people that contributed over a
Yeah. I mean,
quarter
I think you would
century.
say Chom really brought it to life. Nick Szabo, he was pretty instrumental. There was a few others. Obviously, Adam Back with his work in the hashing function, the spam filter. But there's really a core set of probably five guys that kind of got us here over a 25-year period.
Yeah. Well, you needed proof of work,
Hmm.
right? And it needed to be reusable. So that's how. And you needed, SHA-256 or some sort of hashing function uh, as part of the proof of work. You needed a very inspired design. The difficulty was a very inspired design that we don't see really in other sources.
Hmm.
Um, anyway, it came together.
Well, so step back 1 second. I mean, we can stay on the
Yeah.
slide, but one thing that you hit on that I think was very insightful was that most systems that work, they need some sort of standard, some sort of universal standard. For
Mhm.
fiat systems, we use a reserve currency right now, the dollar, and that's sort of the universal standard that gets used around the globe, but it takes a long time to spread. But with computing systems and networks, there's protocol standards, and those are pretty common these days. And when you see new technologies come into the internet or what have you, there's usually a lot of players. There's no standard. They're all doing clunky ways of trying to, achieve the same goal. Eventually, there will be some sort of standardization, and then you see those numbers shrink quickly down to one or two protocols that really drive the basis of it. And seems like what Bitcoin's been able to do in this protocol standard that is really kind of being built out. I mean, you have the crypto side. I view those as more like credit card networks, but you're seeing some standardization around how they do things. A lot of complexity, a lot of whiz bang stuff, most of it not useful, but it's hard to say that none of it will be useful because we've seen this with the internet and the different protocols that every decade kind of drove different business models. So I think the important point there was the standardization, and Bitcoin does seem to be winning that standardized protocol for how we most likely deliver money and create this value layer that can be useful in many different ways other than number go up.
I'm making an additional point. There are two kinds of standards. There's standards for protocols like TCP, IP, et cetera.
Mm-hmm.
And Bitcoin brings protocol standards to the game and
Mm-hmm.
is layered on that standard network. I'm talking about a precise scientific measurement standard that never existed in history for money with 15 digits of digital precision.
Gotcha.
The dollar is a moving target.
Mm-hmm.
Gold was a moving target. We've never had a ruler. We've never had a precise monetary standard the way that we
Mm-hmm.
have for the meter, for the kilogram, for the second.
And in that 15 digits, we see 8 in Bitcoin, but the 15 digits, I think that's a key point because if you just look at it simply, everything in a dollar is kind of two digits, right? So if you 99 cents, you add the other one, it makes a dollar. So it's much less supportive of people where the fractional nature of Bitcoin in terms of you can divide it out 8 digits
We're
as more
7
values.
digits ahead of the decimal point and
Yeah.
8 digits after. We have 15 digits, right?
Yeah. So
2.1 quadrillion.
you
That's
support a lot more people.
nothing's ever been so finely defined for money.
Yeah.
Right? Yeah.
Yep. That's a great point.
Yeah. So what we have is we have 21 gigawatts, roughly. It's uncertain, but certainly within a factor of 2. And it runs for a block, 10 minutes roughly. And throughout that 600 seconds, it's running. I just checked, the latest was over 1,000 exahashes. We're in the zetascale era now. We're now in the zettahash domain, 1 zettahash.
So explain that a little bit. I don't follow the hash rate as much. I mean, I know, what it is and all, but the depth and the size and kind of the relationship of power there, if you can break it
Sure.
down just a little bit.
Yeah. Look, one high-end system today produces hundreds of terahashes. So that's hundreds of trillions of hash set computations. That's not a single computation. A hash set, which is a double hash, a double SHA-256 hash, is actually over 1,000 bit manipulation instructions or operations. It's about 1,600 bit level operations, which are, shuffle and very low level stuff. But ASICs are highly, highly optimized for them.
Mm-hmm.
So you're doing a set that has 1,600 bit level operations. You're doing on one machine hundreds of trillions of sets every second. That's how optimized these designs are. And if you try to do that on a GPU, it's not going to run at terahash rates. It's going to run at mega hash rates. It's going to be hundreds of thousands to 1 million times slower on the fastest NVIDIA Blackwell GPU for their servers right now.
So that makes sense. I mean, if I'll simply step back, where most people might be a little bit have a better understanding of kilobytes to megabytes, megabytes to gigabytes in
Mhm.
file sizes, and also in our just kind of bandwidth and Wi-Fi networks. You know, you read the labels and 100 gigabytes or 1,000 megabytes, or whatever it may be that you're looking at. So that's, even if you don't know computers that well, you kind of start to recognize what those terms and sizes mean for whether you're dealing with your Wi-Fi or whether you're dealing with data. And so what now kind of go get where you're going. What's important, and I think this is important to understand, as you see this transition to a new network that drives, say, GDP or whatnot of the world, is that you're also seeing a transition in our power centers, our utility companies, as they're having to tie directly into these server farms that are needing these upgrades from GPUs to ASICs and whatnot to be able to run the future of our information, because we need that higher compute power. Um,
Mhm.
and these are just
Mhm.
the numbers that sort of show what that means. So I think I posted the other day that Ethereum had kind of stated they want to be a decentralized virtual compute for the world. Um, Arguably, you can do smart contracts a lot better. There's a lot of kind of issues also that leads to hacking and whatnot on those networks. But
Mhm.
Bitcoin, while staying, sort of dumb and simple and less complexity, has actually kind of achieved that. I think you see that in the hash rate. And as more users come onto this network and we start to figure out different layers for scaling, then it's actually achieved both money and the decentralized compute power where Ethereum's sort of stuck due to the complexity. I don't know, it's a
Yeah,
long-winded
agree.
way of recognizing how you're putting that together.
Yeah, agree. So here's a quote from, well, I call them money 1.0, 2.0, and 3.0. That's gold, fiat, and Bitcoin.
Hmm.
And these are this chart in the color coding has the original attributes from Aristotle for money. The first four: durability, portability, divisibility, scarcity. And then I've also added fungibility here. Bitcoin's dark green in every category.
Hmm.
And this scarcity, it's not just scarcity, it's absolutely defined finiteness as a Buckminster Fuller said by the year 2000, there would be a realistic scientific accounting system. Wealth is energy. And, so he predicted at least a ledger that was energy based. And that's
Hmm.
what Bitcoin is. It's a decentralized triple entry ledger that's energy based at the heart.
It's kind of amazing that these guys see it 50 years in advance.
Yeah, he was only off, a few years. That's
Yeah,
pretty.
he was not off very far.
So, that's why I call it Zeta scale. And I've talked about what's here. Originally the very first ASICs came into around 2013, and they were a million times slower than they are today. But the latest stuff is in high integration technology. It's down at 5 nanometer tech. The fastest GPUs, I think, are at 3 nanometers. So it's pretty similar. And you can get 300 to 800 terahertzes, in a single mining rig. And there must be about 5 million, at least at those rates, uh, given you've got some old equipment out there, you're going to need more than 3 million systems around the world to get that 1,000 exahashes. X is a billion, for people that aren't familiar with the exa term. And one zettahash is a billion trillion. So that's a billion times a trillion that the whole network is doing every single second. And, consuming 21 gigawatts to do that. We think it's good that it's consuming a lot of energy, but it's also not, it's not going to be the thing that takes down the grid. That's going to be AI that takes
Yeah.
down the grid.
Well, there's something, I mean, all work, so that's the proof of work. If you're not putting energy into something, like you're just digging a hole for a post, right?
Mhm.
If you put no energy forth, there's no post that's going to be in the ground that holds up a fence. So there's some energy that goes into that seems like lost time, but the value of that, fence post and the fence over time is much more useful than the energy that went in, which is kind of your point. We are using a lot of energy, but if these network foundations lay the foundation of our future for a long, long time, and they're potentially, most likely, but let's just say potentially to be nice to those that don't believe. If they provide that stability forever, then the energy use is kind of required and irrelevant. To your point, the AI side is something much to worry about much more. And when you have these networks requiring much more energy than what we're accustomed to using in our power networks and grids, these actually stabilize grids and
Right.
take energy in places like Africa and some of these other countries that don't have energy and they're using to set up energy systems. Whereas just the AI side competing with that could be troublesome because you've got a lot of energy used to create dead content, memes and things like that.
So exactly, when you get onto this topic, there's something people never recognize, and that includes a lot of us inside, Bitcoin community. And you get into these arguments about energy usage.
Hmm.
Almost all energy usage is single time, single use.
Hmm.
So all of the residential, almost all the commercial, and then about half of the industrial is single use. So over 80% is you're just burning it, one-time use of electricity.
Yep.
Whereas Bitcoin is a production, it's a manufacturing production process of a eternal asset that is increasing in value and that can be
Yep.
reused over and over and over at very low friction,
And you're
circular
and you're
economy.
using to that point, you're using I don't know the details of it, but some of the waste energy from other systems.
Yeah,
Bitcoin is using that, or like with the grid stabilization, say you're in a low energy usage for the residential and the commercial and the traditional industry. And if that energy is created by the power plant and not used, it's just wasted.
right.
Whereas you can flip Bitcoin mining rigs on and they use that energy. And then when high time comes back into play, they just turn them off. So it stabilizes it.
It's a great load balancer and grid stabilizer. Now, this is a proof point that it's not just supply that matters. Energy and the amount of cryptographic work you do matters too. So you look at Bitcoin and Bitcoin Cash, they have the same supply, they have the same algorithm. Bitcoin has 1,000 exahashes. Bitcoin Cash has 3 exahashes.
And I'll
So
step in
it's
right here. For those not aware, Bitcoin Cash was just a fork of Bitcoin, meaning a copy. And they wanted to change the size of the blocks and how much information could go in those to make it basically you could manipulate it more. So Bitcoin is the truer version of the Satoshi white paper.
and the ratio of the price and the hash rate is about 100 to 1. If you price in dollars and measure in exahashes, the ratios for both is around 100 to 1. So Bitcoin Cash is only reflecting in its price roughly the amount of hash power that's going into it. So you need finite supply and you need lots of hash power. This is just power laws everywhere. I've talked about this, but this just shows some of the power laws in nature. And you can have power laws that are increasing in something, it goes up or it goes down. Like we know for gravity, it falls off as 1/the distance squared, right? That's just Newton's law, and it gets a little more complicated in general relativity, but basically like that. Or they can go up. Like the last one's for the Higgs boson, and it has terms that are square terms. The little 2 is a square, the little 4 is the fourth power. There's some field strength, and then this gives an energy level. So that's something that's increasing and fairly steep if it's a fourth power. So Bitcoin is like that, increasing and fairly steep.
So one quick
Yeah.
question on the Bitcoin Cash, is the I guess Bitcoin Cash not having the relationship to the terahashes and the hash power, is that kind of Metcalf's law applying at that level, meaning you need
Yeah.
some squaring to support the network, and Bitcoin Cash just doesn't have that.
It doesn't have the adoption. It doesn't have the security. So what's the first thing you want in a store of value?
Secure.
It either has to have intrinsic security, or you've got to buy a vault to secure
Mhm.
it, put your gold inside the vault, right? So Bitcoin has very high embedded security, and the time chain or the blockchain is exponentially hardened. You can't unwind it because it's exponentially harder as you go back each block.
Mhm.
And then it has that amount of hash power. So it's the most secure thing around. So people are naturally going to gravitate to it. And that's what happened. I mean, Bitcoin Cash could have won out in principle. And if it had it, all the hash rate would have gone to it, right? And it would just be the other fork of the two, and it would be the one that won out, and it would have all the hash rate and all the security and all the price and value and market cap. But the real original thing won out. And, it was flexible enough to adapt
A little
without change. Yeah.
facetious kind of dad joke here. It's the whole Bitcoin Cash debate is proof that you can't just throw money at things and win. I mean,
Yeah. Yeah.
it just doesn't solve problems,
Yeah.
because
Yeah.
that's was sort of the Bitcoin Cash attempt. So sorry, you can keep going. It's just
That's good. So this is just showing the difference between exponential and power law, but plotted two different ways. So these are the same curves, the same mathematical relations on both charts. But the chart on the left is a log linear chart. That is, it's logarithmic in the y-axis, it's linear in the x-axis. The one on the right is a log-log chart. It's logarithmic in both axes. So if you have a log linear chart and you have an exponential function, it's just a straight line on that kind of a graph. But if you go to a log chart, an exponential looks like it, concave climbs up, and a power law is straight in log-log space.
so
It
that's
also
why we
means,
see both of these in Bitcoin at the same time. Some functions of both of these.
yeah,
Okay.
yeah, we'll come on to that. And but it also gives you a little bit of insight as to how exponentials can be unstable, because it just starts going towards infinity, and nothing can, in the real finite world we live in, can go to infinity and absorb, all of the globe's wealth into one asset in no time, right?
And
So,
that's to your early point where there's four laws that have to be present. It, the law of gravity takes hold if you're trying to go into infinity, and then obviously the
right.
energy side as well.
There's a gravity analogy that pulls us back to the power law at some point when the bubble breaks. So an exponential, the equation looks like some constant. It's two parameters, some constant, and this exponential function, and a ratio of time. These are both functions of time, t. And then there's a characteristic time, which is, so it's t over t sub c. T sub c is this characteristic time. So if you have an exponential, you have a characteristic time. If you have radioactive material, it has a half-life. So that's the characteristic time for that. A free neutron decays in 10 minutes on average. That's the characteristic time.
So is the characteristic is just the longevity, so the time that thing lasts.
Yeah,
Okay.
exactly. The half-life, or we call the 1 over E life, when it falls by, the base of the natural natural log exponent.
Okay.
A power law has also two parameters. One's just the leading constant, it's just a scale of everything. Now time is raised to some power instead of being inside an exponential function. So there's no characteristic time. There's no characteristic time. But the important thing is the power law needs to start at some time zero. And that's wherever the phenomena begins. So that's, the center of the sun for gravity, right? And it's January 3rd, 2009 for Bitcoin with the Genesis block.
So there's a roundabout way there to tie in, and it's completely different topic, but Peter Thiel's 0 to 1. So those 0 to 1 technologies, they happen once in a lifetime, every couple of decades. But for that time zero, when that new thing, whether people realize it or not, so just use the Facebook example, that drastically at time zero, when they launched, drastically changed the way communication happened for people around the world.
Mhm. So if you look at a short stretch, you might be able to fit some data with either the exponential or the power law. You might find they both give you decent fits. But if you look at a very long stretch with many orders of magnitude, you're going to determine which one is more appropriate. I think that's the main takeaway. Okay, here's an exponential. So this has got a price, on the y-axis from 1,000 to 6,000, and then it's got a linear time from about 2005, the past 20 years. And it looks pretty much like log linear. It's a straight line. It's an exponential. Uh, well, what is it? It's the S&P 500.
I was gonna say that looks like the S&P 500.
Because it's 6,000. So,
Because I was just looking, I was like, that does not look like Bitcoin.
yeah,
And what cued me in was that 2008 low there.
right, right. This
Like
Great Recession is marked.
when you sit through that real time and see prices do that, it's hard to get that out of your brain.
Yeah. So since the bottom of that, it's grown at about, which is where the line starts, and I actually started the line on purpose with Bitcoin. It's been about 12% compound annual growth. Market has outperformed a little bit its long-term averages over this
Hmm.
stretch, but it was starting from a very low point in January 2009, which is not coincidental, right? Because Satoshi was motivated by what was happening in the Great Recession. So that's
I
a
have a
straight,
question,
yeah.
right quick. And the reason why I ask you this because your depth of knowledge in this, and I've always kind of contended I don't really care who Satoshi is or whatnot, but it's hard to see a single person have that depth and breadth of so many very difficult topics to be able to put this all together.
Mm,
Do
mm.
you think that's? I mean, your world, you're in with a lot smarter people that maybe do have brain power to be able to fit all these things together. Is it more likely that it was a group of individuals or potentially one individual? Again, not really caring like who Satoshi is or whatnot.
Yeah,
But
I think it's a single person who obviously was aware of everything that had on in cryptography,
hmm
in the prior decade and a half. That was in communication with other people and was aware of these other projects, and
just
that had, a very inspired approach to the design, and
hmm
maybe got lucky a bit with that,
yeah.
but really good choice of design and the parameters of the design. Quite amazing.
It's always struck me. The reason why I asked is always struck me like the ability to grasp all the most important characteristics of a monetary system and then tie
Right.
that to all the most important characteristics of a compute networks and then tie that to the most important characteristics of cryptography. That's where I was like, man, those are three very difficult just areas and large and wide and you could get really off course. So I thought that was what
Right.
was unique.
Yeah. There are people like that. People like von Neumann and
So you're saying
Oppenheimer and so forth.
I don't have the right friends.
And it sounds like, to me, the writings sound like a single voice. It doesn't
Yeah.
sound like a group writing.
Yeah. Okay. It's just something I've always
Yeah.
just kind of wondered because of the depth of the entire thing.
Now, this is Bitcoin. Power law fits on a log chart. The black line is an ordinary least squares, where you just take the log of the price and the log of the age. And these are log base 10. And then you just fit a straight line through the normal ordinary least squares method of those respective log series. And what you get is a parameter K is the power law index. You get a value 5.69, close to 6. Or you can do something a little more sophisticated, which is called quantile regression. And I won't go into the details, but it allows you to kind of find different levels. So I've got 5 levels here. There's like a 20 percentile level. There's a mid-level, which is the red line. And that turns out to be a median. And then there's an 80% level at the top, which is a red dash line. And the slopes of all those lines are a little bit different, and they tend to converge up towards where we are now. The red line is the kind of middle of all that.
Mhm.
And you can see it's a little bit different from the back line, but not that different. It gives a 5.83 slope, a little bit steeper. And then
The
based on
quantile
that,
regressions are pretty helpful as we've moved in these
yeah.
later cycles.
And they give you a sense of, where the bubbles might go, right?
Mm-hmm. And
And
they
you
help,
start,
if you think about it from traditional finance, they help frame a valuation metric in a roundabout way.
yeah, absolutely. I mean, you could just use standard deviations off of an ordinary least square, z-scores, right?
Mm-hmm.
So that's another way of doing it, but quantiles give you a nice visual. So right now, the fair values of those are in the 87 to 97,000 kind of range. So we're a little bit up above fair value. We're still in that kind of transition zone, trying to get up into the bubble is where we are right now. And then you can project forward a year, and these trend lines would be around the 125 to 135K level.
So it's drastically, and this is what I appreciate about your work. It's kind of level-headed. It's drastically different than what you might see on crypto Twitter that thinks, in the next month or two, we're going to go to $1 million coin and hyper Bitcoinization and this and that. Do you have any? I have some thoughts on that. Do you have any thoughts on that?
Well, a lot of it is engagement farming,
Yeah.
and a lot of it is, natural human desire.
It,
Um, yeah,
it's interesting to me. The ethos is to kind of break free of the fiat mind, but a lot of that nature and just kind of get rich quick or get a big number quick is very fiat minded in
absolutely.
and of itself.
It's completely opposed to the, low time preference, right?
Hmm.
That Safety talks about a lot,
And it's,
we could, yeah.
yeah, it's not an alignment with the white paper either. Um, that, I guess that's how things go in history. But I do have one question. So the R squared value, kind of the, I guess, you know, 96, 7%,
Mhm.
which to my understanding tells you if something is a power law or if the power law is breaking.
Right.
Is that based on the K and the years value? So if that were to drop drastically, does that say, okay, Bitcoin is no longer, or whatever you're measuring is no longer uh, or applying, or what? How am I trying to say this? Is no longer following the characteristics of a power law.
Yeah, I mean, if the price went flat for 5 years, then your overall best fit K would drop, right?
Okay.
And your R squared would drop as well.
Okay, so that year term means where you would have to have price basically not going up over that period would start to break the power law. So
Right.
let me frame that. So I think 1981 gold hit 800 and something dollars an ounce. And then 27 years later, it basically went lower drastically, but then declined for 27 years until 2008. So it never went higher than 800. whatever the high was, 800. So in that instance, if K at that point in time for gold was 8, it would
There
have,
was no K for gold. K was not following a power law.
yeah. No,
Gold was not
sorry.
following a power law.
I'm saying if it had been, and I'm just making up numbers,
Oh, I
if it
see.
had been
Okay.
following a power law and the K was 8, at the 9th year, you would say, okay, the power law for gold, if there had been one, was broken. Am I thinking about that correctly?
Well, yeah, except it takes longer and longer because of the scale-free nature. So what really matters is doubling the age. So going
Okay.
from 1 to 2 years, 2 to 4, 4 to 8, 8 to 16.
Okay.
So actually, to see how the power law develops, we've got to go from 16 to 32. And
Okay.
this is where people start to get twitchy, That, in other words, that's another way of saying that the returns are slowing. But fortunately, the returns are still very high. They're like 3% a month or 40% a year, 41% a year.
So, so then that is also, though, helping you build that foundational value, because that to go from 16 years to 32 years, you need more capital to trust
Right.
that thing and to come and stay in and not just, which kind of helps explain why the volatility declines over time, because capital is not just moving in and then moving out really quickly. It's moving in and staying there. So if you think about that chart of Jesse Myers that Michael Saylor uses, where you got Bitcoin at 2 trillion and then all the other asset classes, which is like 900 trillion or whatever total, that's how Bitcoin becomes 4 trillion, then 8, 16, whatnot. Is that the right way to
Yeah,
think about it?
the doubling time right now is 2 years. And it's going to slow to, 2.5 and then 3 years, right?
So as it gets bigger, that's technically slowing of the power law or the phenomenon
The
behind it.
power law keeps the same index. The growth rate is a derivative of the power law.
Okay,
It's a first derivative of the power law.
gotcha. Okay.
Yeah. So fortunately, we're still at 40% year over year. And you go out to the year 2045, which is the year Saylor likes to talk about, we'll still be at about 20%. So we're going to be well above, um, long-term stock returns and even NASDAQ returns for the next 2 decades.
Would because we're kind of on this institutionalization of Bitcoin and Saylor doing what he's doing and Metaplanet copying that and a lot of these other balance sheet companies, does too much capital coming in too quickly impair that? If we speed up and pull forward those returns too fast, does that matter at all?
Well, you have to define the amount of that. Look, the amount of capital that has to come in is itself a power law. And it's just also the first derivative, basically. So if the price and the market cap are growing as, say, the 5.8 power law, the amount of capital coming in has to grow as about the 4.8 power law.
Okay.
So that's a lot of capital that comes in, more and more each year has to come in. Like right now, you have to have hundreds of billions, even with a multiplier, right? A market multiplier, which might be 2.5 or something like that.
So you would take current price to basically 1 minus the power law because the first derivative? Is that to figure
Yeah.
out how much capital would need to come in
Yes.
to keep
You take the
sustaining it?
first derivative. Yeah,
Okay.
exactly. Yeah.
Okay. That's interesting. So then we could say for Bitcoin to continue to grow and be that supportive network, we need to have X capital this year, and then you do it again, you continue out in the
Right.
future. Okay. I think
So,
you've talked about
people
some of this.
people always say, "Oh, well, we're going to get $1 million Bitcoin because all of these, companies are adopting Bitcoin treasury strategies and strategic reserves starting to be built here and there." And my response to that is, well, those are necessary because we need bigger and bigger pools of capital coming in just to sustain the power law. You need
Yeah,
you
so
need
like
that.
in an exponential, when you get that blowout you need more and more energy. And for Bitcoin with the power curve, that energy is greater and greater capital. So you can't sustain that curve if you're only buying in $100 increments. Those have to be tens of thousands of dollar increments when they come in.
Yeah, and so actually one has to kind of recompute the Metcalfe's law effect and try to correct, because these are all custodians, right? I mean, even a strategic Bitcoin reserve is a custodian
Yeah.
for 300 million people, right?
Do you think that matters at all? I mean, we've shifted, like, self custody was the premise of Bitcoin. And what I mean by matters at all, does it change what's important to Bitcoin and what was unique and made it what it is? The security features, you
Well,
do it yourself. But we all these institutionalization of Bitcoin and even down at the retail level have now moved to, okay, we probably should custody because most people,
mhm,
the
mhm,
masses, just don't want to.
mhm.
Does that change things from your perspective?
I think self-custody was something early adopters did. And, I think we've crossed the chasm. And we're in the early majority.
Hmm. So it's
And
just,
so you can't expect everybody to do self-custody. You just
yeah,
can't, I don't think. Yeah,
like you can't expect everybody to host their own email servers, even though you you can if you wanted to.
right. I mean, how many people are going to run full nodes,
Yeah,
really, realistically, right?
yeah.
So you could do gold. This is quantile regression for gold. You see the same thing, power law. The slope is slightly different. It's 5.58 because, as we know, gold has, been going up in price relative to fiat. But it doesn't look all that different. You see the same, bubbles and so forth. The other interesting thing, and this is true in the fiat curve too, is that these lower quantiles, like the 0.1, 0.25, even up to the 0.5 median, they're all very bunched up. So that's what we call the power law core. It's very tight. And
Hmm.
then, they get stretched out as you get up into the bubbles, which are basically exponential and sometimes super exponential.
And that's us. Is that the support floor that you sort of
Yeah, that's the
define along
support.
the way and you come back to?
That's the support. And if you put the 200-week moving average, it pretty much tracks with this as well.
The traditional finance guys will love that.
But weeks, not days.
Yeah. Well, I mean, it's just a comfortable. It's
Yeah,
kind of like, oh, I understand that when I sort of use it.
yeah, yeah. This is, I think, the simplest way to show that both the returns and the volatility are coming down. I just lumped everything by how monthly returns by epoch. So each one is, 4 block years up until a halving.
Hmm.
And so these are the 4 epochs prior to a year ago when we had the fourth halving. And the orange curve was the average monthly return at epoch, which started out at 30% during the first 4 years, fell to 15, fell to 10, fell to 7.5. So that came down a factor of 4. Volatility did roughly the same thing. Now, if you had an exponential, that would be equal compound annual growth across the whole history. And it would be that gray line. It would just be flat all the way across, which it's clearly not.
Hmm.
So the volatility has come down by a factor of 3.5.
I mean, I remember 2018 or so, it was around 200. Now
Mhm.
it's 40 or 50, or you've got it even lower than that. So
Well,
yeah.
this is a slightly different measure than,
Mm-hmm.
the usual. This is just the volatility of the 48 monthly returns in an epoch.
Mm-hmm.
Yeah.
Now, one thing I did was chart the introduction of futures, options, ETFs, and options on ETFs, and there was a just using daily returns. There was a noticeable drop
Mhm.
post each instrument as well. So it's almost like we got two factors working naturally as power laws increase across time, the vol shrinks. But also as we put more traditional products on top of it, that also, because it gives them some ability to push around spot markets.
Right. And this one shows the stability of the power law and when it kind of locked in. So if you go all the way back to 2011 and compute, okay, here I am sitting in 2011 and I want to compute the power law, just looking backward, not using any of the forward data, right? The
Mm-hmm.
power law I would have computed would have been 8.4. And then it kind of shot up because there was the 2011 bubble. And then it came down through 8. And then before the 2013 bubble got going, in that trough, it dropped down to 5.3. But really, since 2013, it's been relatively stable, with the 2013 bubble carried it up to 6.6. And then it dropped down. And even by the time of the 2017 bubble, it didn't move around much.
Mm.
So for that whole time, since 2016, so almost for a decade, it's been between 5.8 and 5.6, basically.
Is that a number regardless of the underlying, let's just say you were looking at waves or something else in the world
Yeah.
that,
No,
that
this is
function?
just the average through all the waves. Yeah.
Well, no, sorry, waves like physical waves. So, like in the ocean, is there a natural range which a power law number exists, or does each underlying network or thing you're looking at have to establish its own consistent number that like here we're looking at basically 6?
Yeah. Well, it's the latter. In other words, you could say, you can invoke Metcalfe's law and say, okay, uh, Bitcoin is growing in accordance with Metcalfe's law. And so you ought to get something like a square of adoption, maybe a little
Right.
bit less than the square of the adoption. But then
Hmm.
you have to go out and observe how
Right.
fast is the adoption growing. And
Hmm.
when you do that, you observe that the adoption has grown roughly as the cube,
Yep.
is the third power of Bitcoin's age. And then, 2 times 3 is 6. So you expect a power law of about 6.
6. Okay.
And,
So
and
then
that's what you get.
that's applying the Galileo. That was the one thing that I found very interesting in the scale book was the chart where it showed the foundation of anything that supports something is a squaring nature to give the right amount of support to the
Oh,
volume that it can
yeah.
carry, which is
Yeah.
cubing.
Yeah.
And so when that relationship 2 by 3 breaks, and it's not exactly 2 by 3, but generally speaking, when that breaks and that cubing becomes at a higher rate than is sustainable by the squaring, the whole network break or whatever whether it's a
Yeah.
house or
It's
whatever.
it's Godzilla. Godzilla's not possible, right?
Right.
Because the weight overwhelms the legs that have to support it.
And
So that's the
so,
cube and the square. Yeah.
yeah, what was interesting to me, if you're seeing money move to the internet, so the internet TCP/IP basically, my guess is that cubing or squaring and cubing broke once so much information, so much video, so much um, memes and content generation, so the volume portion became
Mhm.
too great for that squaring foundation of TCP/IP, and we had to have another base protocol or another innovation on top of TCP/IP to be able to carry information
Sure.
plus
Sure.
value, and there was no other
Sure.
way around it, um, because otherwise the internet would just crash.
The best software is layered.
Hmm.
And certainly the best protocols and network protocols. I mean, it was 7 layers, right? In
Right.
the traditional model.
Yep.
And so if you want to scale, you need layers. This is the problem with Ethereum. They tried to load everything into the base layer.
So that
So it
squaring and
turned
cubing is
into a
off.
monstrosity. Yeah.
Yeah. So then theoretically, each layer probably has its own 7 layers which maintain that, and it doesn't have to be 7, but each additional layer has to maintain that general relationship for it to
Mhm.
provide stability throughout a
Mhm.
power law life cycle. All right, that makes sense. Sorry, keep
Yeah.
interrupting you.
Yeah. No, it's relevant. Yeah. Um, okay. In stock market, the academic economists talk about efficient market hypothesis, and then you get guys like Taleb that say, no, 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 we have power law tails and blacks, then you get black swans, and not from Taleb, but so there's a lot of studying of, what happens when you get beyond 2 sigma,
Mhm.
and whether efficient market hypothesis applies, whether things are mean reverting. And I'm not going to go through all this, but this is just a summary literature review that somebody did in 2021. Is the Bitcoin market efficient? So they looked at 25 different studies. There were some other cryptocurrencies in the mix, but it was mostly about Bitcoin. They all had Bitcoin as part of their studies. They used a bunch of different tests, one of which I might talk about, the Hurst exponent test. And they found for 20 out of 25, no, they rejected EMH. They rejected efficient market hypothesis for Bitcoin behavior. And they also all missed the power law theory model, but they were right about it not behaving like efficient market.
I personally dislike the efficient market hypothesis.
Yeah, well,
I mean, I think there are some validity to it for like the S&P, and when everybody crowds into something, everybody generally does the same thing, which makes um, information, um, the informational asymmetry moves out, but I still think it's there for those that are willing. Like you said early on, problem with traditional financial people is they don't uh, basically don't do deep research, don't do deep thought. They just take it the face value, and so that allows efficient markets to exist in traditional markets, but those who do dive deeper will find asymmetries. Um, obviously that's what the hedge fund industry is about, but yeah, I've never liked efficient market.
yeah. Well, every big bubble is about to,
Yeah,
disproving that.
that's proof.
Yeah, yeah. Okay, Hurst exponent is one way of asking if something is efficient market. And this guy was a hydrologist, and he was working in Egypt looking at the storage capacity. And so he was doing statistical modeling, and he came up with this method. And it's kind of it's a power law of a different sort. And it's been applied in a lot of different areas. Hydrology is where he was applying it, but it's been applied in complex systems, in geophysics, in network internet traffic analysis, and in finance and economics and other areas. And here's what it looks like. What you do is you have to change your window size over your data set and see how this power law changes as a function of the window size n, which is the number of data points. And how big is your range,
Mhm.
within that window? And then what is the standard deviation of the window? And he found that things can behave in this form into some power h, an exponent, and that's normally confined to 0 to 1. And furthermore, he found that 0.5 for this Hurst exponent h is a random walk, and above 0.5 is persistent trending, and below 0.5 is mean reverting. So the higher number means that you've got something interesting and surprising, inefficient market, which is an opportunity for alpha, shall we say.
Mhm.
Now,
That's
this
the
is
asymmetry piece.
yeah. So this is a study that was done by somebody in 2023, and they looked at emerging market stocks and they looked at Bitcoin. Um, they had about 8 years of data for both. They didn't look at Bitcoin prices on the weekends, only during the days. And the way they did their residuals is just by looking at daily variations in prices, percentage wise, or log ratios is normally how people do these things. And they found 0.6 roughly for Bitcoin, which is shown here in red. It was always above 0.5. At one point, it goes to 0.75. So they did find a non-mean reverting non-efficient market nature to Bitcoin, and more so than for emerging stocks, which is in blue.
So
However,
I think, oh, go
go
ahead.
ahead. No, you go.
Well, I thought what was interesting there is you see how they do kind of sync up through 2018. So if you think about traditional equities, emerging markets, sort of non-correlated,
Mhm.
they generally go differently because the way that the dollar plays factors into, and the way U.S. debt that they have, they can't access dollars, factors into it. So they're generally a non-correlated asset. There's periods where they do correlate. As you can see in this chart, it looks like Bitcoin follows that to about 2018. It kind of breaks down, but still generally follows that. But then you see that dislocation in 2022. And what I've started to notice in the trading prices, you could see big footprints, old school tape reading, uh, 2017, 2018, after that top. You saw footprints come in that was institutional in nature in the way that the trading behavior changed. And
Mm.
Bitcoin did start to correlate more with traditional markets. And at many of the turns in recent years, Bitcoin tends to lead traditional markets. It'll
Mhm.
get out of
Mhm.
sync here and there, but so this was interesting to me because it kind of
Okay.
did prove that early non-correlation. But as you can see at the very end, the two are kind of going different directions, which
Right.
shows Bitcoin being more correlated to traditional assets these days.
I say that Bitcoin is all the risk off combined with all the risk on plus all the reward that I need.
That's pretty accurate.
Yeah. Okay. So the problem they did is that they were not aware, that author was not aware of the parallel nature.
Hmm.
So what I did instead was use a longer data series, but more importantly, I um, used the parallel nature of Bitcoin in order to calculate the residuals. So the residuals are in log price terms, above or below the main power law trend, which I did with a quantile regression 0.5 median level. So that was how I detrended. And then I applied, over the full history, both with daily and weekly data. And I did this for Bitcoin priced in dollars, and I did it also for Bitcoin priced in gold. So that's why I've got green and yellow there, green being dollars.
I think that's unique that you do the pricing in gold. I've not seen a lot of other people do that. And the reason why I think that's unique is because to date, gold is the only money to last throughout man's time. So our human history has been reliant on gold as that base monetary unit, that base measuring stick. So I thought that was interesting.
Yeah. I was a coin collector when I was a kid. And then, during the 1970s, interest in gold, follower of Harry Brown, reading his books and stuff, and
Hmm.
got quite interested in precious metals back then.
All the
Um,
smart guys are either gold guys or bond guys. It's not the equity guys.
not the equity guys. There's some very smart bond guys. Yeah, you ask an equity guy what convexity is, and a lot of the time they don't know, right?
He just says, "What's the price going to be tomorrow?"
Yeah. So I get very high Hurst exponents. For the weekly, 0.87, 0.89, depending on whether it's gold or dollars. That's a very strong trend. And for the daily, 0.96 and 0.97. And you need a lot of data points to do this because you're taking these windows of different sizes, so you're slicing it a lot. And I have, you have 5,000 data points with daily, so you put more confidence into that one because you like to have 1,000 data points or more. So the daily numbers are really, really strong for the Hurst exponent. Uh, okay, and to validate it, I did SPY, 10 years of daily prices, and the H value is 0.18, which is, not even on the chart here. It's strong mean reversion. So most of the time, actually, the SPY is mean reverting.
Hmm.
And this shows the history now. You break it down, and to get to this and take time steps, which are 1 quarter, 1 calendar quarter, you have to go to hourly data. So I went to hourly data and applied the same thing. And you can see it stays above 0.92 for the entire history. And the thing is color coded by whether it was in the core or the bubble, green being the core, power law core, and red being the bubble, and yellow transition zone. And actually it's the bubbles kind of pull it back down and the core pulls it back up in terms of Hurst exponent.
Is there any, just looking at this simplistically, is there any, say, on average, you get a certain number of red, green, yellow dots? Obviously, the red defines the
No,
bubble period.
that's definitional. So you can either, normally what I do is you can define it with or without the transition zone. And normally with the transition zone in there, I would take the upper 40% as being the bubble, and the transition zone 20%, and the lower 40% is the core. Or more simply, just divide it at the median and above and below.
Above and below.
It doesn't matter too much. You can do something called hidden Markov test, and you get kind of a similar division. So it doesn't.
Okay.
Yeah.
And the one thing too, the very bottom point, very high inefficient market, slowly coming down. To me, that's what the flaw of an efficient market is. That it assumes just like an average, everybody's going to play around and do the same thing. But what creates opportunity in markets in life is the ability to capitalize. You might be taking a lot of risk, but capitalize on that one or two or handful of out of the ordinary events or the thing that other people don't see. And I think if we're in a market where it's efficient, everybody's seeing the same thing, there's no opportunity. Why would you participate?
Right. We've had alpha for 14 years. We're going to have alpha for another decade or two.
Yeah.
Yeah. Yeah. This shows that the residuals are not a Gaussian. You can fit it pretty well with dual Gaussian. So one is the core, the other is the bubble. These are the log 10 residuals. So the difference in the means is 0.4 in the log, which is a big number. In linear space, that's like a factor of 2.5. And then the bubbles are much wider. They're wider by a factor of 3 in log space. You can do it against gold. You get the same kind of bimodal distribution. You can try to fit by a unimodal gamma distribution, and it doesn't work. It doesn't catch the first peak, and it doesn't catch the dip that you've seen between the two peaks here.
So I have two questions. So one, this is showing visually, is it correct to say it's showing the declining nature of the bubble tops for Bitcoin? Is that
No,
correct? No.
there's no time axis here. This is the probability density as a function of the size of the residual.
Okay.
So it's just a distribution, it's just a distribution of the residuals.
But they're shrinking over the
There's no
residual.
time. It's not shown here. The time
Okay.
axis isn't shown, but they do shrink,
Yeah.
but it's not shown here.
Okay.
Yeah.
That's what I was
Yeah.
confused. Is like, does that show the shrinking?
No,
Okay.
it just shows the bimodal nature. It shows that there's this division between this core behavior and this bubble behavior, and the core behaves like a power law.
Gotcha. The
The
two
bubble
halves.
are exponentials that rise and crash back. That's what it
Gotcha.
shows.
So that's like the earlier chart where you had the exponential and the log and log linear. It shows the two different behaviors inside of the power law.
Right. This is another way of seeing it. The chart here has that hidden Markov model, which, doesn't really make any assumptions. It kind of says, based on what I've seen, where am I now? And you can see that it very cleanly divides between the core behavior, which is mostly below the median, but not always, and the bubble behavior, which is mostly above the median and not always. So it maps pretty well with just making an arbitrary cut at the median.
Well, so I think that second point there, missing the left and right tail, you're missing all of your risk if you don't capture those, right? The
Yeah, yeah.
unexpected things that happen in a traditional bell curve.
Yeah.
So one
And
other
you see the peaks coming down here too. You see the volatility coming down, right? And the power in the bubbles is coming down.
yeah, but there's two ways to look at that from a volatility standpoint. The ability to capture that volatility, which is still very high, slows over time. So some of the gaming it from a profit perspective reduces. But I think the other thing to continue to build trust in that network and the ability to use that network for a revenue generating purpose other than trading goes up as that volatility comes down.
Yeah.
Because the stability and the trust and the security of it increases in the broader masses mind.
That's what brings the institutional money in.
Yeah. So the term gamma, one quick question on that. The term gamma is so in options, that's the rate of change of delta, which is the rate of change of the underlying. In
Right.
Bitcoin, what is the term gamma? What is it? Is the rate
Well,
of is it still a rate of
that
change of something or is it
that gamma
completely
is
different?
different from the gamma used in options.
Okay.
Um, I looked at the higher moments of Bitcoin distribution. I don't have any slides on that here. Skew kurtosis higher moments,
Mm-hmm.
but which is related, to gamma in options. But this is a different use of the term gamma.
Okay.
This is a particular mathematical distribution that has a long positive tail on the right side,
Okay.
and is not that good a fit, basically. So I was
Okay.
just saying, well, can we fit this with a single curve? And the answer
Right.
was no. You really need two,
Two.
and it can be two log normal. The Gaussians, they're really log normals, two log normal.
Okay. That was
If you,
just a
yeah,
point for myself when I saw that term. I was
yeah,
confused at what it would be. Um, what would be the underlying that would be
yeah.
measuring?
Now here, this is price versus age log, but you've taken away the bubble. So you're just looking at the power law core, and then you run quantiles on that. So it's half the data, and you run quantiles on that, and it's really, really tight. They're just
Mm-hmm.
right on top of each other. And the R squared is incredible, 0.998. And power law is a little bit steeper. So the power law core is even steeper than you think and even tighter than you think. And this is the fundamental reality for the long-term trend. And the bubbles are things that come and go, and they may be kicked off by liquidity, and they may require lots of herding and FOMO, to keep
Mm-hmm.
them going and develop.
Would you be more concerned if you saw this R square drop or the other?
Oh, this one,
Yeah.
this is the one that matters.
Yep.
This is another way of looking at it. It shows you the width, because the green band is not very wide, doesn't move around
Mm-hmm.
that much, right?
Lack of
Um,
interest. Those are in bottoms.
and it shows that we started to enter into the bubble zone at the end of last year. And
Mm-hmm.
I don't have this year's data plotted on, but we've been below, and we're kind of back in the transition zone at the high end.
At the end of last year being 2024, just for those
Yeah.
listening. Yep.
And then gold, um, it hasn't quite done the same thing against gold. It hasn't gotten out of the transition zone. And to get out of the transition zone with gold, it would have to get to about 40 ounces. And right now we're roughly 1 kilogram, 30 something, low 30 ounces.
So still a ways to go.
still a ways to go. So I think, 120K would get us into bubble zone probably. And, but to confirm that, you'd like to see 40 ounces relative to gold.
Okay.
This is just a kind of an analogy with turbulent flow that we see in physics. And this particular analogy is with the heartbeat in the aorta. With every heartbeat, you have both laminar steady flow, which is like the power law core, and then you have this turbulent flow, which is like these bubbles on top.
Yeah, and Scale, the book Scale did a good job of discussing that and talking about the importance. So, and I may have it backwards, you can correct me, but when you get that pump as it comes out of the heart and it hits the main parts of the body, you need that steady flow. But as you get down to, your fingers and toes and all the smaller capillaries that go further out, you need that speed to velocity to kind of to reach and carry it the final distance, which is that turbulent.
Yeah. Well, this is turbulence in your largest artery in the aorta itself. And, too much turbulence would not be a good thing. It's when
Right. Yeah.
atherosclerosis is building up, right? And so they
You get
actually
those,
measure this, in clinical settings.
get the blowout.
Yeah. Um, this just shows how the residuals have come down over time, from a linear factor of 3
Hmm.
down to about a linear factor of 1.6 relative to the median. And the core is kind of running along at about 70% of where the median is. So a fair value, it's a little less right now, but let's say it's 100,000, then the core would be down at around 70,000. And that's not the low point, but it's kind of the middle of all those lower half of the data. And then 1.6, 160K, that's not the top of a bubble. That's
Hmm.
kind of the middle of a bubble zone. And then, you could go, I mean, normally you talk about z-scores relative to the median, right?
Right.
But you can talk about z-scores just within the bubble data and think about +1 standard deviation, +2 standard deviations just within the bubble data. And
So you have
that's,
an yeah, you
yeah,
have an overarching fundamental value of just Bitcoin in general, and then you say, okay, well, if I think we're in a downtrend kind of bear market, here's where I would expect the average to be, and then if I think we're in a bubble in a smaller window, here's where I would expect the average to be, and you could use that to look at what is current quoted price relative to that average in that smaller framing. So you kind of have three different um,
right,
valuation models that you could use.
right. This shows bubble to core ratio, how it's come down. It was close to 5. Now it's a little above 2. These are price ratios, and it's fallen as inverse linear power of 1, reciprocal model, basically. And this, again, is volatility core and bubble reciprocal model. It really hasn't changed in the core, but it's come down a lot in the bubbles.
So the declining nature. Okay.
And then these are these different levels that you were just talking about. So on the graph, the orange, the blue, and the green lines are respectively the core mean, the overall mean, and the bubble mean projections with their power laws. And then the dashed lines are 1 and 2 standard deviations above, but only using the bubble data for those standard
Hmm.
deviations.
So in
And then
a
this,
high, we could say, well, maybe 125 up to 250.
right. And it kind of depends on when. So if it's at the beginning of 2026, age 17,
Hmm.
1 to 2 standard deviations is 185 to 234.
Hmm.
But 2 standard deviation in the plus tail, normally you think of it as a 2.5% kind of chance. But in
Right.
this case, it's 1.2 because I'm only using half the data, which is the bubbles. So it's
Gotcha.
compared to the whole data set, it's only a 1.2%
So then you kind of
chance.
use your Kelly criteria and gambling math to say probability of positive or negative outcome. So you can set your allocation levels based on that. If you were
Yeah,
building like a full investment model out of these things.
right. I just had this idea about yin and yang that kind of corresponds to the parallel core as the yang, the core structure and growth,
Hmm.
less volatile, and the yin is the chaos and volatility that we get in the bubbles. ChatGPT thought that was okay. This
I,
is
I
Kelly
li-
Frack. Yeah,
I like it. Yeah.
yeah, I like it. This is Kelly fraction, the derivation. There's a lot of work that went into this. It was done in the early 50s. Kelly worked at Bell Labs with Shannon, who's the information theory guy, figured out
Hmm.
how to do signal to noise analyses and data
And if
that you're
you
transmitting.
if you read their work and Shannon's, I mean, you're seeing that applied in the AI and the mesh, the graph networks and all the stuff that's really coming into play in terms of what's behind the probabilistic nature of what's the next word that you're going to type into AI or what's the next thing you're going to want to know. And you're seeing that baked into our systems and also seeing it in the Bitcoin side of things, which ties together your point about AI and Bitcoin coming together.
And, you can use it in, portfolio management to decide how much of your portfolio you want to put into Bitcoin or something else. And it assumes a log utility function, which turns out to be optimal and also plays well with human psychology because we hate losses,
Hmm.
right? We hate losses twice as much as we value wins. And so what you want to do is you want to grow the log of your wealth. And then if you have a series of bets and you say, what's your fraction that you win? And then how much do you win? Then you can go on and calculate um, basically a curve and that tells you what the optimal betting size is, which depends on two numbers. It depends on your winning fraction, which in this example is 60%. So let's suppose you've got a loaded dice, you win 60% of the time, you lose 40%, and let's suppose it's an equal payoff. This is what the curve looks like.
Hmm.
And you do not want to bet half your stake. You only want to
Right.
bet about uh, 20% of your stake. You basically, in this case, you just take P minus Q, where P is the win rate and Q is the loss percentage. So it's 60% minus 40%.
So I think that's important because in modern Bitcoin culture, it's go 100% long Bitcoin. But
Yeah,
when you do that, you're ignoring Kelly's work because it says anytime you kind of reach over that center point of this curve, then you're pretty much guaranteeing a zero outcome at some point for some unknown. You never know what that reason is.
right.
But in the gambling, you go on a run of winning streaks, which is awesome. But then you have to consider what happens when you go on a run of losing streaks, and neither of them is 100% at any point, but they could be at one point.
Right. So here you're going to lose money once you get at 38%. And if you bet 25 or 30, it's suboptimal.
Right.
So that's the principle. And so um, then the big question is, do I use monthly or quarterly or annual data or full cycle 4-year data? The problem with full cycle is we've only got 4 data points, right?
Hmm.
So that's pretty dangerous trying to build statistics on that. So I think as far as you want to stretch it would be annual data. This is only 10 years. It's not the full history, but we know the returns were really high in the beginning. So actually, they'd make us be even more optimistic. So taking the last 10 years is a little bit on the conservative side here.
And I think for investment purposes, that makes sense. Even when you're dealing with data sets, smaller data sets, you tend to pull out the abnormal pieces, the highs and lows, and look at the middle. And we just know that because there are very few people trading Bitcoin or using Bitcoin or what have you in kind of the pre 2016 era, it really distorted price a lot more than the realities of it as more of a mass class, and their psychological behaviors and how they think about and move price around becomes more important.
Right. Yeah, I didn't mention in the intro, I got into Bitcoin personally in 2014, late 2014. And my original use case was, well, I was just very interested in it from the technology standpoint and starting to analyze it, but also to move money internationally.
Hmm.
And of course, the big problem was that I didn't keep enough of it that I was moving, right? Which was,
uh,
learning that we all went through.
y-
Um,
yeah,
so that,
we all have those stories.
yeah. So this is 10 years and it's 16 different asset classes, broad asset classes, including broad tech is probably the number two here. Bitcoin won 8 times out of 10. And of course, when it lost big time, right? It was at the
Hmm.
bottom. So that's kind of what we have to work with. And I've applied Kelly to this grid, except I threw away all the debt stuff because the debt stuff doesn't return very much.
Yeah.
So instead of 16 classes, we had 8. And they're Bitcoin, broad tech, large and small caps, real estate, which I guess is REITs in this one, gold,
Hmm.
commodities, and international stocks. So there are two things you want to calculate. One is the probability of a winning year, and B is the average edge that you have in terms of the win versus loss ratio. And so what you do is you take what's the average return for all your winning years and what's the average return for all your losing years. You divide those two averages, and that gives you this B ratio. So in the upper right, you see B equals those brackets is average win and average loss in the denominator. And you have to flip the sign because the loss is negative number and you want B to be a positive number. And then the derivation of Kelly criteria is this F, which is P minus Q over B, where P was your percentage wins, Q is your percentage losses, which is just 1 minus P, right? But you
Hmm.
divide Q by B. And then that is your ideal, optimal, full Kelly application, allocation in your portfolio. You don't want to go higher. If you're a little risk averse, you can go lower. If you apply that to all of these, you get these F values shown in the green column. Bitcoin 0.75. Broad tech came in at number 2 at 0.66, and then large caps at 0.53. Gold did pretty well at 0.36. And if you say, well, Bitcoin, it was faster in the past. Let's look at only 5 years. You still got 0.71. It's still very high. Now, you can also subtract the risk-free rate from the return. I use 4%. A lot of this time period, interest rates were very low. So
Yeah,
4%,
basically zero.
right, was more than reasonable. If you do that, the Bitcoin number doesn't change, but the other numbers come down. In fact, small caps flips negative. Gold goes almost to zero. And also, the other point here is that we expect R to be higher going forward in time. It's going to be more like 4 or 5 at least.
Hmm.
It's not going to be zero. Commodities really negative. So the best ones were Bitcoin and broad tech. And if you say, well, I want one more asset that's kind of uncorrelated, you could pick gold. And then if you put the three of those together and normalize, you would put 52% into Bitcoin and 42% into broad tech and 6% into gold. But if you just think of broad tech as being fiat and gold as being close to fiat, you could put up to 75% into Bitcoin, right?
Which
And
is your original F
25%
value.
into, it doesn't matter what you put your 25% into cash,
Yeah.
pretty much, right? T-bills, because that's just there for opportunity when you get a crash, Right. When you get a
There's
pullback.
opportunity and reality is you do have to have spending money. And while there are some places you can spend Bitcoin and sats and things, the reality is most places you still have to have some form of fiat as a
Right.
just that's just what everybody measures in. So you have to use that to make it easier on yourself and not jump through hoops just to go buy a Coke.
Yeah.
Yeah, that's
So
pretty interesting.
I, I eat my cooking on this one. I live by this. Uh, we can show a couple more slides. Bitcoin is the power of global liquidity. Michael Howell talks about this. He's a global expert on liquidity. He's got his own index, and he has found a power law with an index of 9.72. Bitcoin price, which he's used the natural log, and his own index, which is on the x-axis. It's not over a really large dynamic range. His index is going from about 11.6 to 12.1. So it's not a huge dynamic range, but it's a pretty decent enough power law. And he finds a good R squared. And the Bitcoin price span here was from about $200 to about 100,000. And he also tested for Granger causality and found that liquidity led Bitcoin price by around 11 to weeks or so. I've redone the same thing. I don't have access to his index, so I use the OECD M3 Global Liquidity Index, but I have a longer time frame and a longer price range. So I've got 6 orders of magnitude here in price, from 10 cents up to $100,000. And I find a slightly steeper slope of 11.5, slightly lower R squared. Doesn't fit that well in the very early years. And but it's certainly reasonable consistency and confirmation. And I don't have time to show it, but what I did show in some other work is that it appears that once the liquidity growth is greater than 7%, it has some predictivity for a bubble about a year later, up to about a year later. We have not reached 7% yet for the OECD growth. The last number is a little over 4%. But liquidity is kicking up, so
And so it does prove
we're
too
positive.
that over time Bitcoin, as it's being adopted in the traditional financial ecosystem, is becoming a liquidity tool. Like it or not, is becoming a liquidity tool. But because that liquidity that now has created some dead assets has to go somewhere.
Mhm.
Yeah, some of it will go away when you have these crashes, and but we still use money as liquidity and a flow to create economies around capital sources. And so it's just naturally becoming a capital source.
Yeah, that's good. That's great. That's a good insight. And, it's ultimate collateral, right?
Hmm.
Bitcoin is the ultimate collateral asset.
Yeah.
So
And we
we
just
certainly
moved
believe
from
so.
land, which was very slow,
Yeah.
gold, which is a little
Yeah.
bit faster, and Bitcoin. So we now have three forms of capital assets that we can build communities, um, economies, products, and whatnot. And we're just still that early on the Bitcoin side, which is the most instantaneously sellable.
And, given that we might want to allocate up to 75%, this is a quote from Warren Buffett about diversification. And another quote about diversification in Wall Street.
Yeah, yeah, and that's what just and I'm kind of wrapped, but the latter one is what I hope that we're able to stave off so that Bitcoin achieves its ultimate capabilities without enough of the kind of siphoning out the middle, creating the spreads and arbitrage around the predictability of the power law that impair it in some manner.
So far, it's not bad. The ETF fees are very low,
Hmm.
and Sailor's innovations are quite nice, I think.
Yeah.
People can get 8%, even 10% income streams. They can get the 8% with a kicker.
Hmm.
So, there are products that are attractive products already.
Yeah, yeah, there's definitely some genius in the roundabout way to get Bitcoin adoption, but do it in a completely different market, in a traditional market that allows it to happen faster than what looks like regulatory environment would allow regular spot Bitcoin and physical Bitcoin to happen. So, well,
Okay.
Stephen, I know this was a little long today, but I definitely appreciate you coming on, your insights, and I'll let you kind of tell everybody where they can find more about you, the shows, and just other information. I would encourage anybody that's really interested in Bitcoin to follow Stephen and to look at some of his work. It's been very helpful for me.
Yeah. Thank you. I'm Money or Debt on Twixter and on Substack. My name, Substack, it's shown in this little quote at the bottom there, somewhat faintly. And then this Physics of Bitcoin show normally would be about, I don't know, 12 hours from now. We're going to skip this week. I have a family responsibility, but normally we hold it Wednesday, 11:15 Eastern time at night. And that's with Giovanni Santastasi, the discoverer of the power law, and also an astrophysicist. So we encourage you to tune in. That's both on YouTube on his channel, and X on his and my channel.
Well, perfect. I appreciate it coming on.
I know.